Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 2nd of March. I'm Daniel Lam, your host for the podcast. I seem to be prearranged in the media interviews whenever there's a major geopolitical event. Well, at the start of the year, I had a media interview in the morning right after the operation in Venezuela. And then today, I will be appearing at another interview, no doubt with many questions about the events in the Middle East over the weekend. Now, I believe you all have been flooded with media reports on the events, so I would like to concentrate upon the impact in the financial markets. So, as one would expect, there is a spike in Brent crude prices, up 7% at the moment of the creation of this podcast, to $72 per barrel. Now, the moves in the other asset classes are relatively contained. For example, in the Australian and Japan equity market, and gold is up mildly by just over 1%. Now, oil prices is the main channel of risk to the financial markets. We see three oil price scenarios. So a temporary rise towards $80 per barrel, similar to mid-2025, based on limited conflict and the return to negotiations. Now, this is our core scenario, a relatively short-lived spike in oil prices. It would be similar to the 12-day war in mid-2025, and at that time, oil prices rose temporarily to $78.4 per barrel, but quickly returned to around $60 per barrel as an end to hostilities resulted in the focus returning to the significant excess oil supply. Now, in such a scenario, there's unlikely to be any lasting impact on inflation and risky assets beyond short-lived sentiment. The other two scenarios are a quick fall in prices should all sides return to the negotiating table quickly, or a sustained rise in oil prices above $80 per barrel from a prolonged disruption in supply, impacting growth and inflation. For investors, they should be focusing upon hedges, including energy sector equities and inflation-protected bonds. Now, U.S. energy sector equities offer moderately high correlation to oil prices, while U.S. inflation-protected bonds give exposure to any rise in U.S. inflation concerns. Gold remains our preferred asset class, as it is likely to benefit from any search for safe havens, something that central banks and also investors will continue to pursue in this geopolitical tensions that is prevalent under Trump 2.0. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.